Look around. The headlines don't scream 2008. There is no single collapsing subprime market, no sudden failure of a major bank. This crisis is more insidious. It is a prolonged, decades-in-the-making structural unwind. We are not merely facing a failure of liquidity, we are confronting a deep global solvency crisis defined by three toxic pillars: record global leverage, geopolitical fragmentation, and interest rates that punish the entire debt pyramid. This is the World Perspective Analysis, a rigorous, multifaceted look at why the system is structurally broken and the difficult, intellectually honest solutions required to construct a more resilient architecture of wealth. Part 1. The Crisis Diagnosis. 3. Interlocking Failures. Our first pillar is unprecedented global debt, an economic addiction fueled by over a decade of quantitative easing and zero interest rate policy. The global stock of sovereign and corporate bonds now exceeds $100 trillion. Post-COVID, governments and corporations gorged on cheap capital. Now, the music has stopped. The core crisis is not the quantity of debt itself, but the maturation and refinancing risk. Over 40% of OECD sovereign debt and global corporate bonds must be rolled over by 2027. This debt must be renewed at current elevated yields, transforming manageable liabilities into a crippling fiscal expense. For advanced economies like Italy and Japan, debt servicing is projected to rival or eclipse their entire education and defense budgets. This is the chilling reality of fiscal cannibalism, structurally destroying the capacity for future growth and essential public investment. This dynamic confirms the state's deep fiscal fragility. The second pillar is geopolitical fragmentation, the decisive reversal of 3 decades of neoliberal globalization. The rise of protectionism, the imposition of retaliatory tariffs, and the shift toward friend-shoring have created a fundamental structural shock. From the perspective of the trade economist, the crisis is fundamentally about supply-side uncertainty. Corporations delay capital expenditure when the rules of global commerce, tariffs, trade blocs, market access, are fundamentally unstable. This drag on corporate profits deteriorates debt repayment capacity, particularly for small and medium-sized supplier firms dependent on complex global value chains. This geopolitical drive for de-globalization is directly translating into slower real GDP growth and reduced global trade volume. The third pillar is the monetary policy trap, the central bank's impossible dilemma. Major central banks, especially the US Federal Reserve, were forced to use high rates to combat a form of inflation driven primarily by fiscal expansion and supply-side energy shocks, not pure demand. The system is now trapped in a vicious feedback loop. If central banks cut rates prematurely to ease the system's debt burden, they risk reigniting persistent services inflation and sacrificing their hard-won credibility. If they keep rates higher for longer, they guarantee a wave of corporate defaults, a sharp tightening of credit, and a potentially deep recession. This situation confirms the terrifying specter of fiscal dominance, where monetary policy is no longer independent, but held hostage by the government's massive debt requirements. Part 2. The Relatable Crisis: Consequences of Systemic Risk. For the everyday citizen, this structural crisis feels immediate and painful, manifesting as declining disposable income and rising precarity. The housing trap is a prime example. Elevated interest rates have curtailed lending and sent housing affordability into decline, especially in metropolitan hubs. Homeowners on adjustable rate mortgages now face a significant debt cliff. Economically, this accelerates the dangerous trend of wealth divergence, structurally separating those who own assets with low debt from those dependent solely on labor income and subject to the highest borrowing costs. Furthermore, the public service squeeze is a democratic crisis. As governments allocate an increasing proportion of tax revenue to interest payments, less is available for essential public goods like healthcare, defense, and infrastructure. This is the opportunity cost of high debt. In the Global South, where debt servicing can consume up to 70% of government revenue, this is not just an economic headwind, it is a development crisis, jeopardizing sustainable development goals and increasing the risk of social instability. Part 3. The solutions. Systemic, intelligent, and difficult. Simple solutions are off the table. Fixing this requires intellectual courage and a commitment to systemic reform. First, strategic fiscal re-engineering. Governments must move beyond simplistic austerity and embrace strategic fiscal consolidation that targets inefficiency over essential services. Every dollar of new debt issuance must be dedicated to high-return productive investment in artificial intelligence infrastructure, clean energy transition, and structural reforms designed to boost long-term potential growth. For the developing world, the G20 and IMF must enact a radical reform of their debt frameworks, tying deep debt relief to climate adaptation goals and enforcing transparency. Second, financial resilience and regulatory fortification. The financial sector must be fortified against the next shock. International financial institutions must double their financing capacity using innovative tools like hybrid capital to provide a robust global financial safety net. Crucially, regulation needs to move beyond bank balance sheets to target the opaque shadow banking sector and discourage the use of debt for non-productive financial engineering, such as excessive share buybacks over genuine capital investment. Banks must actively manage their portfolios, stress testing against the high-rate, low-growth scenario we are now experiencing. Third, the investor's mandate, strategic resilience. The individual response to this macro crisis is not survival. It is strategic resilience and capital preservation. This mandates aggressive personal debt reduction, particularly high-interest consumer debt, and a portfolio focused on assets with demonstrated pricing power and low geopolitical exposure. Essential technology, utility infrastructure, and commodities with defensible supply chains. The crisis demands a fundamental shift from passive trust in the system to active financial intelligence and risk management. Conclusion. The structural crisis of 2025 is a complex interplay of choices. The choice to finance short-term consumption with long-term debt, and the choice to prioritize political expediency over systemic stability. But a crisis is also a catalyst for profound necessary change. By focusing on fiscal prudence, regulatory resilience, and strategic investment, we can navigate this structural unwind and begin the difficult process of building a financial system that rewards genuine productivity over leverage. If you want to understand the geopolitical fragmentation driving this economic unwinding, make sure you watch our foundational playlist on De-Globalization and the New World Order. And for a look at how this systemic failure impacts the future skills and cognitive capacity of our youth, check out our in-depth series on Pedagogy Decoded and the global education crisis. Let us know in the comments below, what specific policy mechanism, fiscal, monetary, or regulatory, do you believe is the single most critical leverage point for averting a further economic slide? Like and subscribe to World Perspective for more intelligent breakdowns on global power, finance, and civilization shifts.